The Bank of England's Governor Andrew Bailey just sounded an alarm that feels uncomfortably familiar. Speaking before a House of Lords committee, Bailey said there are worrying echoes of the 2008 financial crisis appearing in the US private credit market. That's right. The man in charge of keeping Britain's financial system stable is warning that history might be about to repeat itself. Recently, two big American firms, First Brands and Tricolor, went bankrupt, and Bailey doesn't think they're just random failures. He's suggesting these could be early warning signs of a much bigger problem. He told the committee the Bank of England was taking a closer look, asking whether these collapses are idiosyncratic or if they're the canary in the coal mine. In other words, are these isolated events or the start of something much worse? He put it bluntly. Are they telling us something more fundamental about the private finance, private asset, private credit, private equity sector, or are they telling us that in any of these worlds, these are idiosyncratic cases that go wrong? Then he added, I think that is still a very open question. It's an open question in the US. Bailey's tone was cautious, but the subtext was clear. We've seen this before. I don't want to sound too foreboding, but the added reason this question is important is if you go back to before the financial crisis, when we were having this debate about subprime mortgages in the US, people were telling us, no, it's too small to be systemic, it's idiosyncratic. That was the wrong call. That's a chilling statement, because back in 2007, the same thing happened. Small cracks appeared in the financial system and everyone said not to worry, but those cracks became a full-blown earthquake. In 2008, banks across the world froze. Credit, the lifeblood of modern economies, stopped flowing. Major institutions like Lehman Brothers, worth billions, went bankrupt overnight. Others, like AIG and Citigroup, had to be bailed out by governments just to survive. The crisis triggered a chain reaction that brought global markets to their knees. It wasn't just a Wall Street problem. Within weeks, the panic spread worldwide, from London to Tokyo to Johannesburg. The modern global financial system came dangerously close to total collapse. The 2008 financial crisis remains one of the most significant economic events in modern history, not only because of the scale of the collapse, but because of how deeply it reshaped the global economy, politics, and even culture. And one thing to remember is this: before every financial crisis, before every bubble bursts, there are always a few people who see it coming. Those who shout from the rooftops that a crash is inevitable. If you look back, multiple experts warned of the coming disaster years before it happened. Take, for instance, Peter Schiff, the economist, broker and founder of Euro-Pacific Capital. His first major warning about the 2008 financial crisis came between 2006 and 2007, widely televised on CNBC and Fox Business.
You're starting to see it in the housing market. You had a lot of people over the past 4 or 5 years borrow a lot of money that they can't afford to repay. They were able to keep it together for a while on these artificial teaser rates. But as these rates are starting to reset, you're starting to see what's happening in the housing market. It's going to throw through to the entire economy, and consumer credit is going to dry up. And we're going to be in a recession, and it's going to be a devastating recession. It's not just going to be a few quarters of negative growth. It's going to last for years.
Stephen, jump in here. What do you say? He's saying it's a disaster.
Well, I really don't see this economy that he's talking about.
Why hasn't it happened yet? Why hasn't the collapse happened? Why hasn't the skeleton, the subprime skeleton, come fully out of the closet and scared the living daylights out of everybody?
It takes a while. It takes a while for this stuff to filter through. Look at how long these hedge funds were able to pretend that these subprime debt securities that they hold actually have value or close to par when they're really practically worthless, if not completely.
And now that they're not pretending anymore, nothing's happened. The world hasn't ended. So one of these days, we're just going to have to stop predicting that this same old thing is going to cause the end of the world.
He repeatedly warned that the US housing market and banking system were in a bubble and would inevitably crash. He later became known as the man who predicted the crash. Another example is Michael Burry, whose first major warning came in 2005. Burry studied subprime mortgage bonds and realized that they would collapse. He famously shorted the housing market through credit default swaps, essentially betting against it. His story was later dramatized in the Hollywood blockbuster The Big Short, where he was portrayed by Christian Bale. As a result of his bold bet against the market, his fund earned over $700 million in profits from the 2008 financial crash. The 2008 crash started with the collapse of the US housing market. When homeowners couldn't pay their mortgages, banks around the world lost billions. They'd invested heavily in complicated bundles of mortgage loans, many of which were far riskier than they realized. When the housing bubble burst, so did those investments. By the time the dust settled, major banks had gone under, governments were bailing out financial giants like RBS and Lloyds, and the world had entered the deepest recession in decades. So when Bailey says he's seeing worrying echoes of that period, he's not just talk. He's referring to the same patterns of behaviour: risky lending, complex financial products, and too much borrowing. He even said, "We certainly are beginning to see, for instance, what used to be called slicing and dicing and tranching of loan structures going on. And if you were involved before the financial crisis and during it, alarm bells start going off at that point," he told peers. That stuff was a feature of the financial crisis. So that's another reason why we've got to use these cases as another reason to have more drains up, frankly. So what exactly is this slicing and dicing? In simple terms, it's when financial firms take a bunch of loans, some good, some bad, mix them together and sell them off as new investment products. On paper, it spreads the risk. In reality, it hides it. This was the same trick used before 2008, when risky US mortgages were repackaged and sold as safe assets. When the truth came out, investors realized they bought financial junk, and it triggered a global meltdown. Now, Bailey says that the same sort of thing is starting to appear again, but this time it's not in housing. It's in something called private credit. Private credit basically means loans made by non-bank lenders like private equity firms or hedge funds to businesses that can't or don't want to borrow from traditional banks. Over the last decade, this market has exploded. It's now worth around $3 trillion globally, and it's almost completely unregulated. Now that's a big problem because it means massive amounts of borrowing are happening in the shadows without the oversight or safeguards that exist in the banking system. Deputy Governor Sarah Breeden explained what's worrying regulators most. It's about high leverage, it's about opacity, it's about complexity, and it's about weak underwriting standards. Those are the things that we are talking about in the abstract as a source of vulnerability in this bit of the financial system. And those appear to have been at play in the context of those two defaults. In simple terms, too much debt, not enough transparency, overcomplicated deals, and poor lending practices. It's déjà vu for anyone who remembers 2008. When America sneezes, the world catches a cold. That old saying captures how deeply the global economy depends on the United States. But today, Britain's economy is so fragile that it feels more like if the US clears its throat, the UK catches a cold. What happens across the Atlantic doesn't stay there anymore. It ripples through global markets within hours, and the UK is often one of the first to feel the impact. The UK's economy is extremely vulnerable to global shocks. After years of low growth, high public debt, and weak productivity, Britain is in a delicate position. The Office for National Statistics recently showed that GDP growth has been flatlining for months. That means there's no real buffer if the global economy takes another hit. Even small disruptions like a slowdown in American lending or a dip in Wall Street confidence could have outsized consequences for Britain's financial system and households. A financial shock from the US could easily push the UK into a full-blown recession. Why? Because the UK is so tightly interwoven with American finance. London's financial sector is one of the largest in the world, and British banks, pension funds, and insurance firms all hold billions in US-linked assets. When the US credit market stumbles, those losses quickly find their way into British portfolios. That in turn affects consumer spending, corporate confidence, and job creation at home. Consumer confidence in Britain is already hovering near recession levels, with households still battling the aftershocks of the cost of living crisis. Business investment is stagnant as companies hesitate to spend in an uncertain climate. Interest rates have made borrowing more expensive, and the government's fiscal room to respond is limited. If another global shock hits, it could trigger a downward spiral. weaker growth, falling investment, and more pressure on already struggling households. Recession isn't just a technical term, it's a human story. It means job losses, shrinking savings, and mounting pressure on families already living paycheck to paycheck. The fear isn't just another mild downturn, but a deeper, more prolonged recession that would be harder to escape this time. The UK government is already stretched thin, with public debt around 100% of GDP and interest payments consuming record amounts. That leaves little room for the kind of large-scale interventions seen during the 2008 crisis or the pandemic. To make matters worse, inflation, though lower than last year, is still above the Bank of England's target that ties banks' hands. Cutting interest rates too fast to cushion a slowdown could reignite inflation. Keeping them high could deepen the recession. It's a lose-lose scenario that makes the UK especially exposed to any turbulence abroad. So, when the governor of the Bank of England warns about worrying echoes of 2008 in the US credit market, Britain should listen closely. If cracks begin to appear in America's financial system again, it won't take long before they show up here too. Because when the US sneezes, the UK doesn't just catch a cold, it risks catching the full-blown fever of a global recession. The collapse of the car parts firm First Brands and the auto lender Tricolour prompted concern on Wall Street, when the JP Morgan chief executive Jamie Dimon comparing them to cockroaches and saying that more could emerge. My antenna goes up when things like this happen. I probably shouldn't say, but when you see one cockroach, there's probably more. And so should everyone be forewarned at this point, Dimon said. The International Monetary Fund's Global Financial Stability Review last week highlighted concerns about the close connections between private credit markets and mainstream banks. And the IMF's managing director, Christina Georgieva, said it was the issue that kept her awake at night. That's not the kind of language that you want to hear from the person overseeing global financial stability. Let's be honest, the timing of this warning couldn't be worse. The global economy is already fragile, with high interest rates, slowing growth and rising debt levels. The private credit boom has always been a way for companies to keep borrowing even as traditional banks tighten lending standards. But that also means risk is shifting from regulated banks to unregulated institutions when no one really knows how much danger is building up. And that's exactly what worries Bailey. Because before every major financial crash, there's a common theme: overconfidence. Before 2008, analysts said that the housing market was too big to fail. Before the dot-com crash, they said tech stocks could only go up. And before the Great Depression, people said good times would last forever. Bailey's warning fits right into that pattern. When everyone says it's fine, nothing to worry about, that's usually when trouble starts brewing. Every crash begins with confidence and ends with panic. Now, to be clear, Bailey isn't predicting an immediate collapse. What he's saying is that the conditions for a major crisis are starting to appear again. Huge amounts of borrowing, complex financial structures, and too much faith in a system that looks stable on the surface but may be far riskier underneath. He's also saying that we need to act before it's too late, because if we want to wait for the cracks to become obvious, it's already game over. This is why he keeps comparing today's events to 2008, not because history repeats exactly, but because it often rhymes. The lesson here is simple. When you see headlines about companies collapsing, regulators warning, and credit markets tightening, don't ignore them. These are the same warning signs that appear before every major crash. That's why the title of this video says it all. This always happens before a crash. The truth is, big financial crises rarely start with a bang. They start quietly, with a few defaults, a few nervous investors, a few reassurances that everything's fine, and then slowly confidence evaporates. The dominoes start to fall. Bailey's warning isn't doom and gloom, it's a reminder. A reminder that financial systems are built on trust, and when that trust is stretched too far, the results can be catastrophic. So, as the world once again chases growth through debt and financial engineering, maybe it's time to step back and ask, have we really learned from 2008? Or are we about to live through it again, just with different names and different players? Because if history teaches us anything, it's this: the same warning signs always appear before a crash. Do you think the world is heading toward another financial crisis? Well, share your thoughts in the comments below. Thanks for watching, and don't forget to like, comment, and subscribe for more.